Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. Today we're going to talk about liquidity, what liquidity means, how to kind of measure it, and why it's really important if you're selling options on the wheel. First, though, if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, document my own journey towards financial independence. So if you I'd really appreciate it if you've clicked on this video so far. Give me a little thumbs up. I'd like that and appreciate that a lot. Subscribe to the channel if you haven't, because I'm putting out videos every Monday, Wednesday, and Friday. Now, we can't sell options on like any stock we've ever heard of because we don't have the options for it. Or if there are some options, they may not be liquid. And that kind of means we can't get a good price to sell them and buy them back. Maybe we can sell them or maybe we can buy them, but it might be expensive and we just really can't get a good price for it. That's why things like SPY are very popular. There's some names that you just see a lot of options on. Tesla, I think NEO is very, it's very volatile, but it's also got a lot of liquidity. You got, what else? SPY. All the big names. The Qs are very important, are very popular. We have T-triple Q. That's another popular one. And all the big names: Microsoft, Apple, Netflix, Snapchat, things like that. Those are really big names. They have plenty of liquidity, and there's a reason why that's important. And we'll go ahead and look at what liquidity is, bid and ask, and that stuff. Okay. All right. So when we have our like basic little options menu thing pulled up, this is like our options table with our calls on the left and puts on the right, and then we always have this bid and ask, and then the mark and the last. Like the mark is kind of what's trading for right now. Last is, the last price it went for. But yeah, our bid and our ask is the difference between our sellers and our buyers. Bidding, so we click on that, it will give us sell. So we can sell this for, 342, or it's a little bouncing around right now because the market's down like 2.5% right now, so it's bouncing around a little bit. Our bid is, the selling. We can sell this put right now for this price, and we can buy a put for this price right now. That's where this is called the spread. Like in this example, we have like a 3-cent spread between the bid and the ask. And usually we like to be in the middle somewhere. It's bouncing around right now, but like if we have like 313 or 310, 314, the mid range is like 312. We see it bouncing around. And we can set our limit price somewhere in the middle. And and the more liquidity we have, the lower this spread is going to be. Now, when we click on market, and if we are buying, it's just going to go straight to the ask. It's going to go like next in line for the ask price. And if we go to sell, it's going to go straight to the bid price. That's why if we do a limit, we can choose like somewhere in the middle. Not too big of a deal for a very liquid market, but something where there's a bigger spread, market and limit are a little more important. If we go to something like Mag Silver, small cap mining company, mines silver, there's not going to be a lot of option liquidity on something like this. So if we see we have a 15-cent spread between the bid and the ask. So if we want to buy or sell anything, there might not be very much liquidity for us to get a good price on buying or selling this. But we can go to the market price. We can sell at the bid, and then we could buy at the ask, and that's going to be 65 cents or $65, and then this will be $50. So there's going to be a wide spread, and this can be a problem in like high volatility markets if things are going up and down a whole bunch. And if we want to sell a put on this for 50 cents, and then we have no liquidity, even if nothing changes, we have to buy that back for 65 cents if there's no liquidity. So we're losing money right away with no liquidity. If we buy, on the market, we pay 65 cents, but then we have to sell it back at 50 cents. So then we take that 15-cent loss. So this is a good example of a low liquidity market. Now, if we want to see what our liquidity is, we have a couple things here. We have volume, and this is how many contracts have been traded today. So for this $15 strike price, we've had 19 contracts traded during the whole day. Market's only been open for an hour, so this can still go up throughout the day. And open interest is how many of these contracts are out there in total. This is all of the $15 puts out there. Now, if I wanted to sell this call here, I can do for the market and put a limit and do this, but it might be a little bit of time before this gets accepted, just because there's such a big spread, and someone has to come and meet me to buy this contract from. Now, if you have E-Trade, you can go to the live action, and this kind of it gives you different scans that you can check for. And I'm sure Thinkorswim and all the big brokerages have some sort of way to show you different metrics for all the contracts. So we just go down here, we look at total option volume, and we can run that. And this will show us right away the options with the most contracts. And we have, so we have SPY, which has the most option volume. Then Apple, SPX, the Qs, IWM, Microsoft, VIX, GE. And these are all have very small spreads, and you can sell options on all of these really easily. You have a whole bunch of them. But then and you can kind of sort it out a little bit. You can go to, where is it at? Go to sort by mark, and this is lowest price to highest price. So if you want to keep position sizing in check, you can just go up to whatever your price is. What do we got? Here's Intel at $44. And then, here's a whole bunch from 44 to 7 that all have a whole bunch of option liquidity. Another thing you can do is just sort out, a watch list. You could put in all the positions that you want to look at, and then you can sort them however you want. You can sort them by mark, and this is priced lowest to highest. You can keep an eye on the bid and the ask. Here's the volume. So something like Clorox has a little bit less volume than everything else, but still, even this Clorox, it has a low bid and ask, so that's still plenty liquid. Most of these companies that, Fortune 500 kind of S&P 500 companies, they're going to be, probably enough liquidity for your average investor. Then another way you do it is kind of sort by IV rank, and this will be, this will tell you where you can get the most premiums from selling a contract. So Target, that's always making big moves. So that has really high volatility right now. It's got the spread 9 cents. We can go in here. So the mid is like 155.19. So there's a little bit of a spread in Target. Spread in Facebook is like, what is that, 10 cents right now? That's really not a big deal if you're selling options on Facebook. And you just take a look. Look at all the spreads. That's a good indicator of, liquidity. Because the more volume, the more liquidity it has, the lower the spread is. But in a time like right now, with the stock market kind of going down right now, spreads might be a little wider. Like on a calm day, some of these spreads will tighten up a bit. Then on like a big day, like if we have a really big market correction, everyone might be trying to sell their options, and liquidity could dry up there, especially for like medium or lower liquidity kind of lower volume positions. Something like SPY or Apple and Facebook, that'll be pretty easy to get, a decent price if you're trying to sell that in a hurry on like a big downtrend, or if there's like some sort of big margin call or whatever happens. But something like Nova Gold, you're going to have a tough time selling that for the market price. You're going to have to meet the buyers. And, if everyone's selling, you have to come to the buyers. The buyers don't have to come to you on the price. And all that little difference between the bid and the ask, that's called slippage. And it's just a little bit of money that you don't get to make on your trade. Less slippage, the better. So that's kind of my spiel about volume and liquidity. Hope you learned something. Hope you get something out of this video. If you did and watched it to this far, give me a little thumbs up. I'd really appreciate it. Go ahead and subscribe to my channel if you haven't, because I'm putting out videos every Monday, Wednesday, and Friday. Put some other videos over here. And then I want you to go have a good day, all right? Justin out.